Welcome back to Commodities Decoded. I am Kishore. Let's talk about silver. Silver can rise 25% in a couple of weeks and fall the same in even less time. If you blinked, you missed the rally and the crash. That's silver, the metal that moves twice as fast as gold, but half as predictable. Silver jumped 170% in 2025. It has been the mother of all bull runs in the history and also the best performer across all the assets in 2025, hands down. Today, we're decoding silver's split personality. Is it money or material? Investment or industrial commodity? The answer is both. And that's exactly what makes it so violent, so profitable, and so dangerous. This is the asset that destroys the overconfident and rewards the nimble. Let's break it down. Here is the silver's fundamental problem. It can't decide what it is. Gold is 90% investment and monetary demand. Less than 10% is industrial. Silver is opposite. Roughly 50% is investment and 50% is industrial. That split creates chaos. Why? Because those demand sources move for completely opposite reasons. Sometimes they cancel each other out. Sometimes they amplify each other. You never know which until it's too late. Imagine a recession hits. Industrial demand collapses. Factories slow down. Electronic production drops. And construction dies. That's bearish. But that's the same recession triggers monetary fears, currency debasement, central bank panic, loss of confidence. That's bullish. Which wins depends on the recession. Deflationary recession like 2008, both collapse. Silver gets crushed. Inflationary recession like 1970s, monetary demand explodes. Silver goes parabolic. Add another layer, market size. The silver market is around $1.5 trillion. Gold is approximately around $15 trillion. So 10 times smaller. That means silver is far easier to move. When money flows in, prices spike violently. When it flows out, they crash just as fast. Silver doesn't just move more than gold, it overshoots in both directions. A 10% gold move triggers a 20% silver move. That's the dual identity premium. Twice the sensitivity, twice the volatility, and twice the risk. You're not investing in silver, you're betting on which identity dominates and when it switches. The gold-silver ratio is sitting around 55 to 1 right now. That means 1 ounce of gold buys you 55 ounces of silver. This ratio is one of the most powerful timing tools in commodities when it comes to gold and silver. When it's high above 90, silver is cheap relative to gold. When it's low, especially below 60, silver is expensive. Historically, this ratio ranges from around 65 to 95 at extremes. The mean reversions happen. In March 2020, the gold-silver ratio spiked to 127, an all-time high. Silver got obliterated as an industrial metal during COVID panic. 6 months later, silver rallied 120% as the silver ratio collapsed back to 65. So how do you use this? When the ratio hits 95 plus, that's historically been a great silver entry. When it drops below 60, take profits and rotate back to gold. But here's the catch. This is a mean reversion tool, not a momentum signal. It tells you when silver is relatively cheap or expensive. It doesn't tell you when the reversion will happen. You need a catalyst. Fed policy shift, inflation spike, supply shock, or something like those. And the time frame is months to years, not days. This isn't a trading signal, it's a positioning tool. You buy silver when it's hated relative to gold, and you sell when it's loud. Simple, but not easy. Silver has a pattern. It explodes late in cycles. Why? Because late cycle is when everything converges. Inflation is running hot, central banks are behind the curve, industrial demand is still strong, and speculative money is hunting for the next big move. Silver checks every box. In 2011, silver went from $18 to $49 in under a year, 170% rally. QE2 was flooding liquidity, inflation fears were peaking, retail investors were FOMOing into anything inflation related. That's what driven. In 2020 and 21, silver went from $12 to $30. Massive stimulus, monetary expansion, industrial demand recovering. Now coming to 2024-25, silver rallied from $24 to $85. Sticky inflation, slow central bank cuts, structurally growing industrial demand from solar and EVs. Is this another late cycle move? Maybe. But here's the risk. Late cycle moves are explosive and fragile. When they reverse violently. Silver in 2011 went from $49 to $26 in 3 months. If you are late, you get destroyed. The lesson? Late cycle silver is momentum, not value. Ride the wave, don't overstay. Let's talk renewables. This is the bull case everyone is excited about. Silver is essential in solar panels. Roughly about 20-25 grams per panel. Why? It's the best conductor of electricity. Solar cells needs maximum conductivity. With solar capacity expected to triple by 2030, this should be massive demand. Except there's a problem. Silver thrifting technologies, that means the new technology which will help use less silver is getting developed by companies which are using less and less silver per panel, down from 20 grams to 15 or maybe even 10 grams in the future. Why? Because silver is expensive. Every gram saved at a scale is millions of cost saving. But high efficiency new technologies like TOPCon or HJT cells sometimes use more silver per watt. So thrifting isn't one directional decline. Advanced panels can increase usage even as simpler ones go down. So we have opposing forces. More panels being built but less silver per panel. Which wins? Right now, panel growth is outpacing thrifting. So net demand is growing but slower than headlines suggest. Beyond solar, what else? EVs use 25 to 50 grams per vehicle and roughly around against the ICE vehicles of around 15 to 20 grams. The new 5G infrastructure is silver intensive. Electronics, smartphones to servers all need silver. The explosion in data centers require humongous amount of servers and each server needs silver. The fastest growing sector is solar, followed by EVs and 5G. But collectively, these still represent maybe around 30% of demand. Half of silver demand is still traditional industrial sources. Electrical contacts, mirrors, batteries, all those things. Here's the question that challenges the whole narrative. If green transition demand is so strong, why has silver been range bound for years? From 2013 to 2024, silver traded between $15 to $30. No sustained breakout. The answer is, investment demand collapsed post 2011 after the bubble burst. Retail left and never came back. Until recently, the industrial demand grew steadily, but it wasn't enough to offset the loss of speculative buying. That's changing now. Investment demand is returning. If industrial demand stays strong, we might finally see a sustained breakout. But we have heard the story before. Skepticism is warranted. Geopolitically, silver supply is less concentrated than lithium or rare earths. Mexico, Peru, China produce the most. No extreme weaponization risk. But costs are rising, grades are declining, and new mines take years to develop. Supply is not elastic. Silver attracts retail FOMO like nothing else. Why? At $70-$80 an ounce, it feels very affordable compared to $4,000-$4,500 gold. People feel they can afford more silver. That psychology creates momentum and bubbles. When everyone is excited, that's a warning. When everyone is given up, that's the opportunity. Now, the recent run-up, silver went from $24 to $85, which is more than 170%. If you are holding, what do you watch? First, watch the gold-silver ratio. If it is collapsing, silver outperforming aggressively, ride it. But if it stalls or reverses, that's your warning. Second, real rates and the dollar. Silver is more sensitive than gold because of its industrial component. Real rates spike or dollar strengthens, silver gets crushed. Third, industrial indicators. The indices like PMI data, copper prices, manufacturing activity, if those weaken, silver's industrial demand is at risk. So if you're holding, the exit strategy have three options. Right now, you can sell a portion of what you're holding, lock in some profits and let the rest ride. Second option, you can do a trailing stop, maybe 10 to 15% every time you can trail your stop and put a stop loss from the current prices away at around 10%. Option 3 is wait for the gold silver ratio signal. If it drops below 60, rotate back to gold. So right now it's around close to 55. If it sustains here, that's your signal. For someone considering silver now, you're not buying at $24, $25 anymore. You're buying at 80 plus or 85 plus. The easy money is gone. So risk reward is risk favorable. If you believe in the structural case, energy transition, supply constraints, monetary debasement, wait for a pullback. Silver will give you one. It always does. When it pulls back 15-20%, that's when you get aggressive. How do you hold it? Physical silver, of course, the ownership cost is higher, the storage cost is higher, liquidity is a big challenge. So physical silver is not a big thing, but you can still hold it. Silver ETF is the best long-term instrument. It's very liquid, tradable, it's very convenient. But it's a paper instrument, not metal, but definitely it's very safe. You can also buy some silver mining stocks. Globally, there are a lot of silver mining stocks available. And again, when silver rises with 30%, mining stocks might even double. So, but it also comes with some operational risks. Companies like First Majestic, Pan American Silver, Wheaton Precious Metals, these are all available on US stocks, which is available through our app also. They are volatile but potentially explosive. As far as Indian market is considered, Hindustan Zinc is the largest silver producer in India and it gives you indirect exposure to silver. But be cautious, investing in companies would bring other risks as well. Know what you're getting into. Silver is not gold. It is faster, more dangerous, more rewarding. It punishes the stubborn and rewards the nimble. Silver's dual identity makes it fascinating and brutal. It's the money when markets panic. It's a material when economies grow. Sometimes it's both, sometimes it's neither. Right now, both identities are being tested. Investment demand is returning, industrial demand is structurally growing, but prices ran up fast. The next few months tell us if this is the start of something real or another false start. Here's what you need to remember. Silver is a momentum game. Buy when it is hated. Sell when it is loud. Use the gold-silver ratio as your guide. Watch real rates and liquidity and never ever overstay your welcome. In our next episode, let's talk about the king of commodities, crude oil, the most geopolitical commodity on the earth. We'll decode OPEC signals, talk about demand destruction, and explore how energy is being weaponized in real time. I'm Kishore. Stay sharp. See you next time.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.